welcome into the program. This is your game plan for retirement, brought to you by Northwestern Ohio's resource for a common sense approach to planning for your financial, investment, and retirement future. He is president and founder of McIntyre Retirement Services. Chris McIntyre, once again joining us, guiding us, formulating your game plan for retirement. And we always appreciate the time, Chris. I hope you're doing well.
Yep, I'm doing well here. We got some good weather this summer around the lake and getting ready to enjoy more of that.
Absolutely. Well, as it's warming up, Chris, remember that sunscreen. We'll talk a little bit about that here in just a moment, I think. But you usually start us off with a tip of the week.
Yep, tip of the week here is, a stock market's correct severely from, quite often. The average drop in the S&P 500 in any given year is 15%. Expect volatility, and typically that happens a lot in the summer months as well.
Yeah, well, there's kind of an old saying about May to Turkey Day or something along those lines, right, Chris? It's just sort of a cyclical thing that has been a trend, but we know that the market never follows trends exactly either, and we never know when that next market downturn is going to happen.
Yeah, you're exactly right, and we're going to transition our discussion today into talking about sequence risk. And, has to deal with somebody who, let's just say they just retired, okay? And, we'll use a hypothetical, and let's say the market falls 20 to 25% in their first year of retirement, and they still have their money sitting in their old 401k in this example. So their $1 million is now 800,000, let's say, after a 20% correction. How do you think that person feels?
Man, seeing a fifth of your life savings disappear, or a fourth of your life savings, 20 to 25%, just because the market decided to have one of its kind of regular periods of volatility. Chris, that would have to be a very scary thing, especially early on in retirement.
Yes, without question, Peter. It's gut-wrenching, nerve-wracking, whatever you want to call it, very emotional. And that's why we, discuss implementing other strategies, and we'll talk about some of that as the show goes on here today. And, about, what are our other strategies versus just stocks, for example.
Yeah. Well, Chris, back to my comment earlier about the sunscreen. I actually spent the weekend outside. My son is a baseball player. We were at a baseball tournament, and I got a pretty good sunburn. And it doesn't take too long to get burned out there in the sun. But the thing is, Chris, I could have been prepared and avoided that, right? Sometimes we forget or think that it won't happen, and then all of a sudden we turn around and get burned. That is something that is predictable. I knew that I was putting myself out into the sun, and it's kind of like markets. Sometimes we get a little lackadaisical and forget or don't prepare for the fact that markets can burn us. There are time to time those market cycles and downturns. However, not as predictable about when that's going to happen as being outside in the sun. But it's kind of an ever-present state of readiness and preparedness that we need to have when thinking about the potential burn of volatility in the market.
Yeah, yep. Hey, you're exactly right. So up here, you go out on the lake and you get all the sun rays. You need to be prepared for that. So you prepare by good sunscreen. The same thing with your investment portfolio. You can prepare for when those severe declines will happen, and they will happen, right? I mean, we can go back and look at the original dot-com bubble. What we have, the market down about 50% over about almost a 2.5 year period. We had the housing crisis in 2008. And then even in 2022, we could say coming out of COVID with the rising interest rates and the inflation threat that we are still dealing with today. Everybody wants to point the finger and blame, inflation on, the current administration, and that comes with the job. But, prices did not come down after the previous administration, right? I mean, we're still paying all of those inflated prices. And then you add on some of the uncertainty around the war here in Iran. And, it is no wonder that things can get volatile, but we say that in the market's at record highs.
Right. Yeah. Chris, this administration, the last administration, and the several administrations before that, going back for about the last 50 years or so, we seem to outspend our revenue, what we're bringing in. And to account for that, we print more money and devalue the dollars. That's inflation. And that has certainly robbed us of some of the purchasing power of our savings and investments. But the market has, over that same period of time, provided growth to help offset that force. However, these periods where the market does not grow, where we are seeing volatility, where we see the 35 or the 50% downturns, we do need to be prepared for that. And why is it that right now this conversation about being prepared for a market downturn feels more relevant today than ever before?
Yeah, the consumer sentiment, people are nervous about where the economy is going despite the stock market being at record highs. And if you look back through history, that will ebb and flow. That market will come down as consumer sentiment, people pull back the spending, if you will. The government spends a lot of money that helps keep things moving. But, we have a consumer driven economy here in the U.S. by and large. And when people pull back or they're putting more money into gasoline for their vehicles, as the popular example right here, where's the dollars going? Those aren't going on vacations. It's just going into your fuel tank. So it's almost like a tax increase, you could say. And, if we're looking at the history of, what the stock market does in times of high inflation, it does not do that well. Yep. Look back at the 70s, you basically have a lost decade there, when inflation was very, very high, interest rates at 15-16% back during, I think it was the Carter
and Reagan. Yeah. Yep.
And Paul Volcker was the Federal Reserve Chairman. So, we all want to blame the president. There's more people involved in all of this, obviously. The Federal Reserve operates independently, and they set the interest rates or the monetary policy to help control inflation. So to control inflation means we need to damage the economy to drive prices down. So a lot of times they do that by raising interest rates.
Yep. We are talking with Chris McIntyre, ladies and gentlemen. If you've got questions, concerns, if you'd like to get your game plan for retirement put together, give McIntyre Retirement Services a call, 419-332-0532, 419-332-0532, 419-332-0532, or online, McIntyreRetirementServices.com, McIntyreRetirementServices.com. Chris, earlier you had mentioned a phenomenon that we have come to know as, it's been termed as sequence risk or sequence of returns risk. Break this down for us. Why does retirement make market downturns more dangerous?
Yeah, if you think about the flow of money in retirement is going to be out of your IRA accounts, okay, or 401ks, not into them during your working years. So, while we're working and that market dives, goes south and corrects, putting those contributions in, you're buying at low prices, and then that helps your long-term growth, reinvesting the dividends. In retirement, when you're pulling 4% or 5% out of your nest egg, and if you had $1 million, 5% is $50,000. Okay? Well, if the market falls by 20% and you now have 800,000, you're pulling, almost 6% out, so it's the rule of large losses, and you want to avoid that and prepare for when those things happen. Have your alternatives ready to go, and I know we talk on the show quite a bit here about, where do we put money in investments and whatnot for retirement, so that we still have some long-term growth. And we talk about the bucket approach. So, typically think of 3 buckets, if you will. I've got some conservative assets in here. My middle bucket, I have some, moderate risk. And then for my long term to battle inflation and, hopefully stocks rise over the course of your lifetime, like, they, have historically done. That's your third bucket. So, you want to have resources allocated because, when these storms come up, kind of like Lake Erie, they come up quick and, all of a sudden that market can be down 15, 20, 30%, in a relative short amount of time. Sometimes it recovers quickly like it did during the COVID time. But then if we go back to the dot-com bubble back in 2000, 2001, 2002, that took a long time to recover from. We were in the middle of a market correction. We hit a recession. We had the terrorist attack. So a lot of things happened back then. And, that's the one that we need to be conditioned for. The last couple we've had with COVID and the housing bubble, the government stepped in so quickly,
Yeah.
and
More short-term volatility because of that propping up rather than a true long-term market cycle or decline. Chris, I know that the market impacts confidence, but when it comes to the effectiveness of the market, I think I'm hearing you say something here that the direction of our money might matter as much, if not more, than the direction of the market itself with how effectively we can utilize the market.
Yeah, absolutely. And, there are growth stocks, there are income stocks, there are bonds that pay interest. We have structured notes that pay a high yield as well. So, how are we building this income portfolio? We have the annuity side of things where, we're at least getting the guaranteed source of income to, help meet those basic living expenses. And, that's where diversity certainly helps you. You want to use many different asset classes to, make sure that you're staying within your risk tolerance and rebalancing those portfolios. If you're a very conservative investor and you're 80% in bonds and 20% in stocks, right? CNBC probably shouldn't be running across your, every device that you have 24 hours a day. You're more invested in the bond market, should be watching the Federal Reserve, not necessarily Wall Street.
Well, I think that, Chris, retirees have dreams, right? Or we look pre-retirement at what retirement is going to be all about, and we have things that we want to do, travel and family experiences and hobbies and things like that, right? But the direction of the market can impact our confidence to do those things. And if we see a down market, we might not live up to everything we thought retirement was going to be and what we dreamed about. So I know that we're not going to avoid market volatility, but planning is about preparing for it, right? We are preparing, not reacting.
Yeah, Peter, you're exactly right. I'm going back here. Another lake reference is the Coast Guard's motto is Semper Paratus, always prepared. They plan for contingencies. They practice for when bad things happen. And that's why you need to have, plan A in your portfolio and then plan B if things don't work out. And that's why, Dave Ramsey, Susie Orman, a lot of the, those talking folks that are very popular in the finance shows, always say, look, make sure you have your emergency funds. My wife and I were just discussing, even this morning, she said, hey, I have X number of dollars in the checking account. And I said, okay, I'm going to take 10,000 of that and invest it back into our investment account because we had too much money sitting on the side. So lazy money can also hurt you as well. And just having, $150,000 sitting in a savings account or a checking account, earning next to nothing when we're dealing with some inflation is to say, hey, I've got to try to keep pace, at least make 3% on my idle dollars.
Yeah. So we want to make our plan more resilient, Chris, and you've hit on a couple of these as we've discussed this premise. But let's dive in. What can help a retiree have more confidence? What are some of the approaches or the strategies here that can make our retirement more resilient and our portfolio withstand some of these market downturns a little bit better? Because I know having some cash sitting on the sidelines has been talked about and promoted as one of these strategies to withstand market downturns. Can we evaluate a few of these options?
Sure. Yeah. Great point to bring up too, buddy. So when we're sitting down trying to create a portfolio and a plan for somebody who's retired, we need to know what are the expenses. That's the first piece, right? Okay. And then how do we solve for that income? So you algebra teachers out there would be very happy that I'm mentioning that, right? Isolate the variable. Yep. And so let's say somebody needs $7,000 a month to make ends meet and they've just retired. They want to do some traveling and whatnot. And, and 4,000 of their need comes from Social Security or Social Security pension combination. So they're $3,000 a month short. Okay. And maybe they have, let's say they have $500,000. So they need $36,000 out of 500,000, and what is that, about just about 7%? That's a tough one right there for sure. So the more money you have put away, the easier it is to solve for that, solve for that gap that you have. So we could look at, buying an annuity for them to get them that guaranteed structure of income to help meet that $7,000 threshold. So we carve off a piece of that nest egg, place it in an annuity, turn the income on. And again, a lot of flexibility on when you want to turn it on. Maybe they don't need it for 3 to 5 years. So we could get an annuity that will guarantee that that payout rate will increase over that time frame as well. So pre-planning is very important here. Okay, so now we've met the basic living expenses, Peter, and then we can create an investment portfolio with some of the other dollars and, maybe spin off some additional interest and dividends, that sort of thing.
Chris, you recently had an interview with reporter Aaron Kennedy about annuities and their proper placement or consideration in a portfolio. Let's take a little shift here and recount that interview with Aaron and your discussion about annuities there and where and when they can provide value to a portfolio.
Chris, so good to see you. A really important topic today, the top annuity income strategies, finding the right fit for you. Annuities can be a great way to create guaranteed income in retirement, but not all annuities are created equal. What matters most is figuring out if an annuity and which kind fits into your retirement plan. And Chris, I feel like when people hear the word annuity, there's often a strong reaction. Why is that?
Yeah, there's a lot of misinformation around the annuity space, and that comes from the insurance side, the life insurance side of our business. And we also have assets that we manage with mutual funds and things like that, stocks. So sometimes the mutual fund industry isn't real big on the insurance industry, and you might get some misinformation out there. And most people have no clue that there are different types of annuities, and and there are good and bad with anything that you can put your money into. So not all eggs in one basket for sure.
Absolutely. And as you mentioned, there are so many different kinds of annuities. Let's kind of stick with these big three right now, Chris. Can you explain how each creates stable retirement income and how they vary in risk?
Sure. Yeah. So the traditional fixed annuity's been around forever and ever, pays just a set interest rate, kind of like a CD pays a set interest rate for a specific amount of time. The annuity itself is tax deferred. So if you had non-IRA money, you're not paying income tax on that. And we would call that very, on the safe side of the portfolio or low risk like we have on the screen. Mm-hmm. Then we transition into the index annuity, which came out in the mid 1990s. And that allows you to have some of your growth linked to the performance of a stock market index, but it protects your principal and your prior gains in most cases. And so for people who want to play the stock market but don't want any of the downside, the fixed index annuity could be a good fit for them. And then on the variable annuity side of things, we don't use those in our practice. You are directly investing in the stock market. You might have a number of layers of expenses inside the annuity. So we typically want to use the fixed or the fixed index annuities for our retired clients who may want to use it as a simple safe money strategy as well, Erin.
Mm-hmm. So it's clear, again, there are lots of annuities. How do you even begin to help somebody determine which kind, if any, is right for them?
Yes. And, it's part of, your onboarding process, listening to the client and what are their goals and, does an annuity help them complete those financial goals and provide some peace of mind? Not everybody is looking for the lifetime income. They just want to use the annuity as a safe money play. So many different types to choose from out there, just like with mutual funds.
Mm-hmm. And timing is everything when it comes to retirement planning. So when is the right time to buy an annuity?
Yeah, and I would say it would depend what you want to utilize it for. Are you just looking to replace a CD that matured at a low rate and you want to do something for the next 3 to 5 years? Or are we looking at structuring a long-term income play?
I see.
So, just listening to the clients and then help them align with their financial goals, provide them some peace of mind.
And finally, of course, we have to talk about Social Security, which functions as a government provided inflation index life annuity, providing guaranteed lifetime income. And determining when to claim Social Security is one of the most important decisions you will make in retirement. And that decision has to take the rest of your retirement plan into account.
Yeah, absolutely. It's we have a very nice software program that we use to help people determine what strategy works the best for them. If we're dealing with a married couple, even people who are divorced and haven't remarried, they may be able to claim benefits off of an ex-spouse, widowed benefits, many different options out there on Social Security, and we're pretty skilled. I'm part of the National Social Security Association. To help people select those strategies that align with their goals, just like with investments, just like with annuities, Erin.
Such an important piece of the puzzle. And it's nice to talk this through with you, Chris, because it's clear there's no cookie cutter answer. So if somebody would like to sit down, talk through whether an annuity makes sense for them, talk about optimizing Social Security, what's the best way to reach you?
Yep, I would give Heidi a call at our office at 419-332-0532. McIntyre Retirement Services is our website. We have offices in Fremont, Port Clinton, and in Perrysburg to serve the Northwest Ohio community.
Great. Chris, thank you.
My pleasure. Thanks, Erin.
Tune into Chris McIntyre's full radio program and visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntyre. Be sure to subscribe.
Well, Chris, a little additional insight specifically on the value, the placement, the merit, the consideration for annuities there in your discussion with Erin. This is one of the strategies that can help make a retirement portfolio more resilient to market downturns and maybe provide a little bit more confidence in retirement.
Yes, absolutely. The basic fixed rate annuities pay that, that interest rate. The index annuities can link your performance to a stock market index, protect your principal. And then they all obviously have the ability to give you that lifetime income as well. So, certainly help alleviate or instill alleviate concerns and instill confidence. And that's obviously a win-win for people in retirement, right?
Absolutely. I think that's what we're looking for. Confidence to live the life that we dreamed about in retirement. And today's program, we've been talking about being prepared for when markets are volatile. What if there is a market downturn, especially in the first several years of retirement, what that can mean? And Chris, we've talked about a few approaches. The bucket strategy approach. You talked about having some cash on the sidelines, and that seemed like a kind of delicate balance. You want some cash, but not too much cash sitting idle. You've talked about the guaranteed income scenarios and the potential consideration and utilization, the pros and cons of annuities here. And all of these strategies have a little bit of both. Right? There are some pros, there are some cons that we have to consider. One strategy, though, that we have not mentioned that I think is pretty heavily weighted on the pros side, Chris, is having efficient tax strategies for our retirement. I know that taxes come with a bill, right? They are a bill. It's pay me now or pay me later. But can you talk to us about efficient tax strategies and how these can help us be more resilient and account for the potential for market volatility even?
Yeah, where to pull money and when. So, like my wife and I, we have Roth IRAs, we have traditional IRAs, we have after-tax money, just in the checking account and in our regular brokerage account as well. And depending on how much money we need, depends on where we want to pull that money from, for example. And so let's say, somebody is retired and they want to buy a second home down in Fort Myers, Florida, for example. Well, they would not want to tap their IRA for that. They would want to use after-tax dollars or the Roth IRA if they have enough money in that for at least the down payment. And then typically the IRA is going to give you your, because that's where most people have their dollars. So we're dealing with, what most people walk into our office with. And it may be 90% of their money is in the 401k or the IRA side, pre-tax. So we help them create tax, other strategies like Roth IRA conversions so that down the road they will have money to tap that'll be tax-free. And we typically want to get that done before the age of 73 because required minimum distributions start then. So, depending on, obviously everybody's situation is different, but, if we have the ability to shift dollars in a tax efficient manner from an IRA account into a Roth IRA account, that money will be tax-free when they make withdrawals, and even more importantly, tax-free to their beneficiaries.
Yeah. Chris, I think a retirement plan should cover these issues that we've talked about today: market crashes, taxation, withdrawals, income, required minimum distributions, inflation, longevity, tax changes, economic uncertainty. I mean, the reality is that the market will always fluctuate, but the plan should remain steady, or should provide us the steadiness to instill confidence into the future years, even in the midst of a market downturn. And it is a great time to plan and prepare for the reality of market volatility right now.
Yeah, absolutely. Planning is just gives you more confidence knowing, hey, I've planned for a lot of contingencies, and you do the worst case scenarios, and then anything above that is obviously better than the worst case scenario. And I think for men, it's certainly something that's more inherent. That's why when we walk into a restaurant, we have our back to the wall so that we can defend ourselves. And I think our investment mindset should be that way as well. And Peter's nodding his head, agrees with me here as well.
I always do that, Chris. Back in my high school days, I was actually in a restaurant that got robbed. And my wife always knows that when I go into a restaurant, I'm going to have my front to the door, my back to the wall. That's the way that I am comfortable. It is a regular conversation, actually, in my household as well. But that's, again, it's something that we have to be prepared for, right? We can't predict if or when anything is going to happen, but we do what we can to prepare for it. And so what happens if the market crashes right after you retire? Well, that depends on whether or not you're prepared, whether or not you have a plan, ladies and gentlemen. And that's, I think, the biggest value and takeaway of this program is that Chris is not here just to provide information or a general conversation on the radio, although that is great. The real value is that he will put your game plan together for you and with you. If you would like a plan that addresses market risk and volatility, your investments, the income that you need, income planning, strategic withdrawal strategies, efficient tax strategies, tax planning and benefits, your Social Security and your Medicare, making the most and best decisions with those, as well as legacy planning. Pick up the phone, start the conversation, no cost, no obligation. That is a courtesy service to put together your game plan for retirement there at McIntyre Retirement Services. And all you need to do to take them up on that offer, give a call and start that conversation. 419-332-0532, 419-332-0532. Several convenient offices located across Northwestern Ohio, one close by to you, ladies and gentlemen, but it's really easy to start with just a quick phone call. 419-332-0532, 419-332-0532, or online at McIntyreRetirementServices.com, McIntyreRetirementServices.com. Chris, thanks for the reminder here each week that it is better for us to prepare rather than react. We want to retire with confidence, and that takes some pre-retirement planning as well as having a plan to last us during retirement. We always appreciate your guidance and the offer that you give to help those proactive savers and investors. Thank you for being here.
Hey, it's my pleasure. Thanks everybody for listening. Have a great weekend, and may God bless America.
Tune into Chris McIntyre's full radio program and visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntyre. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Investment in notes involves risks not associated with investment in ordinary debt securities. The securities are not bank deposits and are not insured by the FDIC or any other government agency, nor are they obligations of or guaranteed by a bank. The securities will not be listed on any securities exchange, and there may be little or no secondary market for these securities, and secondary trading may be limited. Accordingly, you should be willing to hold your note security to maturity. These securities are subject to the credit risk of the issuing bank, and any actual or anticipated changes to its credit ratings or credit spreads may adversely affect the market value of the securities.